Hey guys. So now that we talked about statement of stockholders' equity, I really want to bring you back to what we started this out with. We got assets are equal to liabilities plus equity. I want to add something to that now, and this is our subject for today. Revenues and expenses. So remember, we said that this part is the balance sheet. This next part is the income statement. Another difference between the two is that this is permanent and let's see if I can find another color. This gets redone every single year. So remember that division, but it's important to note as well that these two affect each other. Your balance sheet will, and especially the effect goes this way. Your income statement often changes your balance sheet. All right, let's just focus on this income statement now. And let's focus on a very basic part of it that illustrates this connection between the two. Let me create a new page. So the accounting equation for income statements looks, let me spell it right. If you were to memorize it, you would have debits, you would have credits. For debits, actually, let me say this in another way. This would be for revenues. This would be positive. This would be negative. When you're increasing revenues, you're crediting. When you're decreasing revenues, you're debiting. Next to it, and I'm going to write this a little smaller because I ran out of space, it's expenses. And it looks the opposite. So debits, this is going to be positive, and credits, this is going to be negative. For expenses, when you're adding an expense, you add it right there. All right. This is the basis of your income statement. But what I'm going to tell you is for our purposes right now, you don't have to remember that. But it's good to keep in mind and keep a strong memory of that. All I really want you to know right now from income statements is this formula. Net income is equal to revenue minus expenses. Net income is also your profits, is also your retained earnings, depending on what the question asks for. And this makes sense. If you take your expenses away from your revenues, whatever's left over is going to be what you make that year. If you are selling burritos and you sell $200,000 worth of burritos and it costs you $200,001 to make them, you're losing $1 that year in your business. All right. Let's create a new sheet. The reason why I want you to remember that equation of net incomes is that, let's say your revenues are $200,000 and you spent $199 in wages and supplies and stuff like that to make your burritos. Your net income is going to be $1, and you should feel very proud. But let's say you have this situation. What happens to that $1? Well, what happens is that it becomes your retained earnings, which is the money that you made this year that you are reinvesting, or with retained earnings just in general, think reinvestment. And then if you were to decide to pay dividends out of a penny, those dividends to the stockholders would come directly out of that net income, which is directly part of retained earnings. Remember, retained earnings is added on to yearly. So goes back for the length of the business. So you typically have a retained earning for the beginning of the year. You typically have a retained earning for the end of the year. In the numbers that you will typically get in accounting, because it just keeps adding on to itself. So this net income, let's change it to a different color, goes into the end of the year retained earnings as reinvestment in whatever you want to reinvest it in. So this $1, sorry, that's not the $1. And so this $1 from up here goes into the net income, goes into retained earnings. And then from that total is where you take the dividends out. Hopefully that makes sense. What ends up happening is, because retained earnings is you reinvesting in your business, you're giving stockholders part of that success. And you're drawing it from that account. You're saying, we were this successful this year. Now, as a result, I'm going to give you part of this success before I invest the rest of it into my company. Now, there's one more thing you guys need to see before I continue on. Let's tie this all together, folks. And so there's going to be a big chart. You have assets and debit credit, positive, negative, equals liabilities, what you owe, and with what you owe, those companies that you owe to can take a chunk out of your assets if you don't pay at all, plus equity, which is what stake owners or stockholders own in the business, and any reinvestment. So stock, and then reinvestment, which is debit, negative, or dividends. And then credit, positive, or retained earnings. And then, let's do it in a different color. This is the balance sheet. Let's block that off. Do it in red. This is income statement. What you have is revenues. You got debit. You got credit. You got negative plus. And then you have expenditures or expenses. You got positive, negative. This income, when you total it up down here, will eventually get you net income. Because you'll have a total for revenues, you'll have a total for expenditures, and then revenues minus expenditures is equal to net income. What ends up happening now is the way income statements first affect the balance sheet is that net income affects retained earnings right there. And you're adding to your retained earnings or taking away from your retained earnings depending on your net income. If it's positive, it means you made a profit, it means you have more to reinvest in your business. If it's negative, it means you lost money, it means you have less to reinvest, and it all affects that account right there. Then what happens is that this dividends account affects your retained earnings, because that's where, if the company says we're doing dividends this year, that's where they draw that money from. They're saying this company was this successful, we have money, we don't want to reinvest it all, let's give some of it back to our stockholders. That's a decision that they make, and that's why it's balanced, because you're balancing what you take out of retained earnings with what you've earned. Then, all this represents investment. In your business. So as we have income statement affecting retained earnings, let's use green. This plus equity is influencing assets by being a part of the investment in the business. And that's why when you're typically doing this in accounting and you're typically forming these sheets, you start first by developing income statement, and then second, by developing your balance sheet. Just call it, because of how they're connected logically, your reinvestment, your retained earnings, your income gets put into retained earnings. You need that number triple star it in your balance sheet, and then you can find out the other information as you go along, looking at what's happening. And often both of these get updated simultaneously. So if I'm scrolling down and not destroying my beautiful picture with all the squirrels, I'll let it go. Often you're doing this at the same time. Often you are doing your balance sheet and your income statement at the same time. What I'm hoping that I just did as a conclusion to all these videos is made it so that you guys understand. And let me just fix what is going on. But I hope that I made it that you guys understand why this equation exists and how it works logically, how it comes together logically, so that you understand the concept and you understand how it works together. Now what's left is just practice, 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 practice. Putting this all together. And what we'll see as we practice this, because that's the next best way to do it, is we'll see two other concepts in action. One, how you close accounts. And two, how you readjust accounts and why you do that. But table that's for a separate video. The final thing to concern ourselves about, and I'm just going to do a new document for this to clean up everything, is making sure that we've summarized every sort of single formula that we absolutely need to know, so that we have it all in one place. We talked at length about assets equals liabilities plus equity. The other one to know is debits always have to equal credits. And it makes intuitive sense. If you look at revenues and expenses, debits are positive, credits are positive. Typically, you make a revenue, you have expenses when you have a revenue. These match, but they're not always equal. But because of how it's organized, you can see this at play. They do equal when you take into account balance sheet. And we'll talk about that as we do a problem because it's the easier way to talk about it. But for quickly right now, if you incur an expense for wages, you often have a revenue to pair it with, and that's part of a definition we'll define. But that wage expense will go to liabilities and will become a wages payable on the credit side. And this is just briefly proving this point. I want to prove that so that you guys always understand that no matter what, that happens. That is always there. Let's do the other equations. We have market value is equal to APIC plus common stock / par value. And like in general, these terms get conflated a lot. So just be able to identify when the problem is really saying that. Remember, we talked about how to use this equation to calculate that and that. So when you're developing a statement of stockholders' equity, you may have to consider this. Remember, we also talked about an equation for, well, it's not really an equation. We talked about things like dividends are always taken out of retained earnings. And I think that's it. Let me know if I'm missing something. But I think it all works out. And I think what you'll find is that every time you'll have assets equals liabilities plus equity. You'll have income going into equity as retained earnings. You'll have dividends being taken out of it, and you'll have these sort of conceptually linked to assets. And throughout this whole thing, you'll have a debit equals to credits throughout this whole thing. I'm going to stop now because the next parts of this are more easily explained through practice and talking you through how to appropriately practice these questions. Thank you.